Welcome to your weekly market recap. Everything that moved the markets this week in one place. Stocks, the economy, bonds, crypto, commodities, and metals. It's all right here in one spot. In the next few minutes, you'll get everything that mattered this week, explained clearly and connected into why it all happened. Three big things this week. First, oil came roaring back to life, and Wall Street felt every bit of it. I'll show you why. Second, Tesla dropped hard right after earnings, and the reason isn't what you'd expect. And third, Bitcoin quietly put together a streak that hasn't happened in weeks. What was behind it? That's coming up. Stick with me, because I'm going to break all three of these down, connect them, and show you what they could mean heading into next week. All right, let's start where the whole market lives, the big picture. It was a rough one. All three major indexes closed lower for a second straight week. The S&P 500 finished down about 0.5%, the Dow slipped a touch, and the Nasdaq took the hardest hit, down roughly 2%. So the pain wasn't spread evenly. It was concentrated in tech. Why does that matter? Because when the Nasdaq leads the market lower like that, it usually tells you the story is about growth and valuations, not the whole economy falling apart. And the worst day was Thursday. That was the ugly one. Every major index closed sharply lower, led by communications and consumer names. It was the biggest down day of the week, and it was tied to a jump in oil prices that I'll walk you through in commodities. Then Friday brought a little relief. The Dow actually ended the day higher. The S&P barely budged, and the Nasdaq still lagged behind. Not enough to erase the week's losses, but enough to stop the bleeding. Here's the thing worth noticing underneath the surface. Small caps had it even worse. The Russell 2000 fell about twice as much as the S&P for the week, which tells you the stress wasn't just a mega-cap tech problem. It was broader than that. And the market's fear gauge, the VIX, crept up from calm to moderately nervous as the week went on, climbing from the mid-teens toward 19 by Friday. That's not panic territory, not by a long shot, but it's a market that clearly lost some of its confidence. When the fear gauge rises like that, it usually means investors are paying up for protection, buying a little insurance against more down-eyed. So even Friday's bounce came with a nervous undertone. So where did the money go? It rotated. Investors pulled out of growth and tech and communications names and leaned into energy as oil climbed. That's a classic defensive shift. Money leaving the fast growth story and moving toward the commodity that was suddenly the center of attention. And when you see that kind of rotation, it tells you something about conviction. Investors weren't dumping everything and running for cash. They were repositioning, trimming the parts of the market most sensitive to higher rates and higher oil, and adding to the parts that actually benefit from a crude spike. That's a market that's cautious, but not scared. There was one more thing simmering in the background this week, too. A fresh round of tariffs added to the general unease. It wasn't the main driver, not even close, but it was one more reason the mood stayed jittery, one more variable investors had to price in on top of the oil story. So going into the weekend, the picture was a market that had taken 2 weeks of losses, gotten rattled midweek, and clawed back just a little on Friday. Bruised, but still standing. Now over to the economy. Because underneath all that market noise, the data actually told a pretty resilient story. Start with the jobs picture, because this was the genuine surprise of the week. Weekly jobless claims fell to their lowest level since 1969. Read that again, 1969. Claims dropped to about 187,000 when the street was looking for something closer to 210,000. In plain English, layoffs are just not happening at any real scale right now. And that matters because a labor market this tight makes it a lot harder for the Fed to justify cutting interest rates. A strong jobs market sounds like good news, and it is, but it can also keep rates higher for longer. And here's a detail to file away. This particular claims report covers the survey week that feeds into the big national jobs report coming in early August. So if this reading is any hint, that upcoming payrolls number could come in stronger than some expect, which would only add to the case for the Fed to stay patient. Then there were the PMI surveys, which are basically monthly report cards on business activity, and they split in two directions. Services came in strong, an 8-month high as the economy's biggest engine picked up speed. But there's a catch worth knowing. A chunk of that strength came from one-off spending tied to the World Cup and the July 4th holiday, and the firms running the survey warned it may not last. Manufacturing, on the other hand, slowed to its weakest pace since March. And here's the interesting part. Factories said they pulled back on stocking up because of the uncertainty around the situation with Iran. So you can already see that regional tension quietly leaking into the hard economic data. Housing gave a mixed read too. New home sales actually rebounded more than expected in June, up about 1.5%, which was a nice little surprise and snapped a 2-month slide. But prices kept softening, down almost 3% from a year ago, as builders offered deals to move homes. And the supply of new homes on the market stayed elevated, sitting near 9 months' worth at the current sales pace. That's a lot of inventory. And it's exactly why builders are cutting prices. They've got homes to move and buyers who are still stretched by high mortgage rates. So the read here is nuanced. Buyers are out there. They just need an incentive to jump in. Put it all together, and the economy this week was resilient but uneven. Jobs running hot, services strong, factories cooling, housing wobbling. Not overheating, not falling off a cliff. And that middle ground picture is actually the trickiest kind for the Fed, because there's no clean signal telling them to cut or to hike. The data just says, keep watching. Now, let's talk bonds and rates, because this is where the week really tightened up. Treasury yields climbed all week to their highest level since January of last year. And the reason was oil. As crude prices surged, the bond market got nervous that inflation could come roaring back. And when inflation fears rise, yields rise with them. Why should you care about a treasury yield? Because it sets the tone for everything: your mortgage rate, borrowing costs, and how expensive stocks look. When yields jump like this, it puts pressure on stock valuations across the board, and that reset expectations for the Fed. Just a week earlier, traders were hoping for a rate cut. By the end of this week, the bets had shifted toward the Fed holding steady, and some traders even nudged toward the idea of a hike. That's a real swing in mood. Now, one reason the whole rates story was driven by the market and not the Fed itself. Fed officials went silent this week. They entered their blackout period ahead of next week's meeting, so nobody from the central bank said a word. Every move in expectations came purely from traders reacting to oil. That sets up next week as one of the most important Fed meetings of the summer. And I'll get to why at the end. And it wasn't just the long end of the bond market moving. Shorter-term yields, the ones most sensitive to what the Fed actually does, climbed right alongside the longer-dated ones, a sign the whole market was repricing for the same oil-driven inflation worry. This wasn't just a U.S. story either. Government bond yields in the UK and Europe ticked higher too, so the inflation nerves were global, not just an American thing. Quick pause here. If this recap is helping you make sense of a messy week, a like genuinely helps me keep making these. It's the easiest way to support the channel. And stick around because there's still a lot ahead. The AI and chip drama, which was a story all its own this week, crypto's quiet comeback, and what's coming next that could set the tone for August. Okay, now to individual stocks, and this is where the week got dramatic. Let's start with the big one, Tesla. The company reported after the bell on Wednesday, and the stock took its hit the next day, falling around 14% on Thursday, one of its sharpest single-day drops in years, closing near $320. And here's the twist. Revenue was actually a record. So why did the stock drop? Because profit collapsed. Operating income fell more than half, and free cash flow, the actual cash the business generates, turned negative. Record sales, but the money underneath them dried up. That's what spooked investors, and Tesla was a big weight on the Nasdaq. Think about what that tells you. The market wasn't punishing Tesla for selling fewer cars. It sold plenty, a record number in fact. It was punishing the company for selling them at thinner and thinner margins. In a world of higher for longer rates, investors have gotten a lot pickier about profitability. Growth for growth's sake doesn't cut it anymore. They want to see the money actually land on the bottom line. Tesla's report was a loud reminder of that shift in what the market rewards. Now here's a fascinating one. Alphabet, Google's parent, put up an absolutely blowout quarter. Revenue rose about 24% from a year ago, and the real star was Google Cloud, where growth accelerated sharply as businesses poured money into AI. On the numbers alone, it was a home run. But here's the twist. The stock actually slipped after the report. Why would a great quarter get sold? Because investors zeroed in on one thing: how much Alphabet plans to spend building out its AI infrastructure. That capital spending bill spooked them, even with the strong results. And that tension, great AI growth on one hand, eye-watering spending on the other, is the exact debate hanging over all of big tech right now. It's the clearest sign that the AI boom is alive and well, but the market is starting to ask what it costs. And that brings me to the AI and chip beat, because this is where the real tug-of-war played out. Intel actually posted a strong AI-driven earnings beat, revenue up around 25%, and the stock fell anyway, about 6.5% on Friday. Why? Classic sell the good news. Investors looked past the beat and focused on weak guidance and trouble in the memory chip corner of the industry. That weakness spread. SanDisk tumbled Friday. Sources put the drop anywhere from around 5 to 11%, so I'll just say it fell sharply, as memory names like Micron and the Korean chipmakers dragged the whole sector down. NVIDIA, for its part, held steady near its recent highs, with no real company news, just riding the broader chip mood. So the picture in chips was split. The AI cloud story roaring, the memory chip story struggling. One more name to note. IBM confirmed a weak quarter, with both profit and revenue coming in light, which backed up the stock's rough patch from the week before. So the scoreboard in tech this week was mixed. Alphabet strong on cloud but sold off on spending. Tesla down hard on collapsing freight. Intel beat but faded. SanDisk and the memory names hammered. It was a week that rewarded results but punished anyone with a crack in the story, and that split is the theme I keep coming back to. Worth flagging for next week, too. A batch of chip and hardware names, Qualcomm, Western Digital, ARM Holdings, are all on deck to report, so the memory chip drama that hit this week isn't over. It's just getting to the next chapter. All right, let's talk crypto, because after a quiet stretch, it found some life. Bitcoin climbed above $66,000 early in the week before easing back toward the mid-60,000s as the broader risk-off mood set in. So call it up early, down late. But the real story underneath was the flows. Bitcoin ETFs, the funds that let regular investors buy Bitcoin like a stock, posted 7 straight days of inflows, the longest streak in about 11 weeks, pulling in close to $1 billion over the run. That's the clearest sign in a while that big institutional money is stepping back in. There was a catch, though. The pace of buying slowed hard by midweek, dropping by about 2/3 in a couple of days. So the momentum was fading even as the streak held. There was also a policy angle. Senate Republicans unveiled new text for a crypto bill, the Clarity Act, with a provision backed by the president, and a floor vote could come as soon as next week, though it still lacks bipartisan support. Traders tied some of Bitcoin's early week strength to that news. And it wasn't just Bitcoin. Ethereum ETFs drew inflows too, so the institutional interest spread a little beyond the biggest coin. And here's some context worth keeping in mind on those flows. Even with this 7-day inflow streak, Bitcoin ETF flows for the whole year are still deeply negative. So this was a real bounce in demand, but it's a bounce off a low base, not a full recovery. The good news for the bulls is that total assets in these Bitcoin funds climbed back above $80 billion, recovering ground lost earlier in the year. Overall, crypto ended the week mixed to softer, cooling off alongside stocks by Friday, a strong start undercut by the same risk-off wave that hit everything else. Now over to commodities, and this, right here, is the engine that drove the entire week. Oil. Brent crude, the global benchmark, surged to 6-week highs, briefly topping $100 a barrel at one point, amid the ongoing tensions in the Middle East and fears about supply. Then it eased about 4% on Friday to settle back near the high 90s. But make no mistake, this oil move was the single biggest story of the week, and you saw its fingerprints everywhere. In yields, in the Fed bets, in Thursday's sell-off. Higher oil means higher gas prices at the pump and fresh inflation pressure, which is exactly why the bond market got so jumpy. Now here's a wrinkle that pushed the other way. U.S. crude inventories actually rose far more than expected. Stockpiles built by about 2 million barrels when the market was looking for a decline. Gasoline and distillate supplies built too. More oil sitting in storage is a bearish signal, and it acted as a mild brake on the price rally even as the geopolitical fear pushed the other direction. And then there's gold. Gold posted its best week since early May, rising a little over 1% to close around $4,060 an ounce. When you see oil and gold rising together like this, it's a textbook risk-off signal. Oil bringing inflation worry, gold offering a safe place to hide. Investors were hedging against higher prices and broader uncertainty at the same time. And that's really the tell of the week. You don't usually see money rushing into both an inflation hedge and a fear hedge unless investors are genuinely uneasy about what comes next. Higher oil is an unambiguous inflation headwind. It complicates life for policymakers and eats into household budgets. Gold's climb, meanwhile, said a slice of the market was quietly playing defense rather than chasing the rally. Two different hedges, one shared anxiety. U.S. crude, the domestic benchmark, tracked that same path, rising sharply on the supply fears, then easing on Friday. Silver drifted modestly higher along with gold, riding the same safe haven bid. Copper barely moved, trading near recent levels with no fresh catalyst, and natural gas was quiet too. So the whole commodity conversation this week really came down to 2 metals and 1 barrel of oil. Everything else was background noise. And that inventory build I mentioned is the detail I'd hang on to, because it's the crack in the bullish oil story. If those stockpiles keep rising, it gets harder for oil to stay above $100 on fear alone. Supply, eventually, has a vote. So let's pull it all together, because this week had one clear author, and it wasn't earnings, and it wasn't the Fed. It was oil. A surge in crude past $100 sent a single shock rippling outward through every corner of the market. It pushed Treasury yields to their highest since early last year. It quietly flipped the Fed conversation from "when's the cut" to "will they hold or even hike?" It fed straight into Thursday's worst session of the week. It even showed up in the economy's own data, with factories pulling back on stockpiling as the uncertainty grew, while gold's best week since May showed investors quietly playing defense. And running underneath all of it was a second story. An AI market split right down the middle, with Alphabet's cloud strength holding up the bull case even as chip and memory names sold off, and Tesla's profit miss dragged tech lower. Two threads, 1 week, and both of them point straight at what's coming. And that's what makes this week worth understanding, not just watching. Almost everything that happened traced back to one of those two stories. Get those, and you get the week. And what's coming is a big one. Let's talk about the week ahead, because this is the payoff. The headline event is the Fed's rate decision on Wednesday. After a week where oil drove yields to their highest since early last year and flipped the market away from expecting a cut, this becomes one of the most important Fed meetings of the summer. Traders are split close to evenly between a hold and a hike, and Fed Chair Kevin Warsh's press conference carries unusual uncertainty because this meeting doesn't come with fresh economic projections to lean on. But the Fed isn't the only heavyweight. The very next morning brings a double dose of data: the first official read on second quarter economic growth and the PCE inflation report, which happens to be the Fed's favorite inflation gauge. Everyone will be scanning that one for whether the oil-driven price pressure is starting to show up in the numbers. And on top of all that, we get a wall of big tech earnings: Microsoft, Meta, Apple, and Amazon all reporting. After Alphabet's cloud blowout and Tesla's profit miss, these reports become the real test of whether the AI growth story can keep carrying this market. And it doesn't stop there. We also get the Employment Cost Index on Friday, another piece of the wage and inflation puzzle the Fed watches closely. Think about how the timing stacks up. The Fed decides on Wednesday. Then, the very next morning, we find out how fast the economy actually grew last quarter and whether inflation is creeping back. Data the Fed won't have had in hand when it decided. Then, big tech earnings roll in that same evening. There's even an energy angle spilling into the following Friday, with oil giants ExxonMobil and Chevron set to report. And after a week where crude was the whole story, those results will carry extra weight. It's about as dense a week of market-moving events as you'll see all summer, and each piece connects back to the two threads that ran through this week. The growth and inflation data speaks to the oil story. The mega-cap earnings speak to the AI story. So next week decides it. Does oil's inflation scare set the tone, or does the AI story reclaim the wheel? That's the question heading into August, and it's why I'd keep both eyes on the calendar. One last thought. Markets don't move on what happened. They move on what people expected to happen. And the gap between the two is where the whole week lives. So, if this helped you make sense of the week, a like really helps me keep making these. Subscribe and turn on the bell so next week's recap finds you. And drop a comment. What's on your radar for next week? See you next recap.